Let's bring on board Mr. KRANTHI BATHINI, equity strategist at WealthMills Securities. Sir, thank you for joining us here on News9. Always a pleasure speaking to you. Now, December saw the highest ever monthly additions in Demat account, and this is at a time when the markets are also at a record high. Now, when I was reading this report, it reminded me of that saying, when your cab driver starts talking about markets, it's time to sell. Does that thesis hold here?
Suyash, good evening and Happy New Year to you. We are having the show in this new year, first time. So, you rightly mentioned the December number of accounts have added. The reason is there is a euphoria in the primary market space. That's what we have been discussing. And also opening Demat account have become very easy to the investors. Trading accounts opening is very easy to the investors. Just the digitalization brought a lot of change in terms of the account opening process is concerned. So that's driving the investors to come closer to the markets. Just with a smartphone, people are opening the accounts and started subscribing for the issues and started trading. So this digitalization brought the change. Coming to your point, once the Warren Buffett says when your hairstyler starts suggesting stocks, that is the time you need to be careful. But given the kind of momentum we are witnessing in Indian markets are concerned, the information is plenty nowadays. Earlier, when we started our careers in markets, the main problem is there was a very less information with respect to the stocks and the disclosures are concerned. Today, the issue is there is too much information, but the crux here is how we are interpreting the information, how we are analyzing the information. That is exactly investors need to habituate at this point of time. I don't think so. Markets are completely overvalued at this point of time. There is still some kind of headroom is there, but as you rightly mentioned, when your cab driver starts suggesting the stocks, but what kind of stocks he is suggesting, that is extremely crucial to take into cognizance before concluding whether the markets are overvalued or undervalued at this point of time. Still, we can see a lot of value in the frontline stocks, and also there are pockets where we can see a lot of earning visibility and also the value in the names. So it's by and large more about stock specific at this point of time. Definitely, you are right. It's a liquidity-led market, and also the sentiment is quite positive. So we are playing a very expensive musical chair. One need to think where the investor will be, on which stocks he will be, which stocks will be there in his portfolio when the music stops. But the million-dollar question is how long the music is going to continue.
All right. And sir, that's why we come to seasoned professionals like you and do not take advice from our cab drivers. So, in a market like this where we are at record highs, Nifty and Sensex pretty much, they did correct, earlier in the week, but we have clawed back most of those losses. Where do you see opportunity?
Yeah, the opportunity is still there in defense space, opportunity is still there, the consumer space and infrastructure space. And engineering and capital goods still offers a strong earning visibility for the investors. Suyash, we need to go with the stock specific action in these stocks, and also any dip in these spaces in these sectors. The frontline stocks one can buy at dips. We have witnessed stock like Hindustan Aeronautics. The market cap getting multiplied from 1 lakh crores to 2 lakh crores. That means the stock created around 1 lakh crores of wealth to the investors in the past couple of quarters. So what we can see, the stocks which have a strong earning visibility, they are performing well. So any dip in these kind of names, definitely it's a good entry points for the investors who are entering right now in these markets. So look for the quality at this point of time. That's extremely crucial for the investors. Probably they may not expect a multi-bagger kind of returns in the quality ones because they're always priced in fully. But their capital is secured. They can be happy with outbeating the markets.
All right. And Mr. Kranthi, like we have been talking about a lot of froth, at least for the longest of time, we have been talking about this froth that is building up in the broader markets, but they, for one, are not showing any signs of a slowdown. We are hitting peaks on a consistent basis, and a lot of retail money is, riding in the broader markets. We have seen that in Amphi data. So what's your opinion there? What should a common man who has just started investing, or maybe has been investing for the last couple of years or so, what should they do, who have made good profits on the small cap and the mid cap space? Should they book some bit of it out or keep riding the wave higher?
Suyash, okay, the best thing is, okay, when we plan to reach one destination within 1 hour, by different factors, if you achieve your goal within half an hour, if you reach the half an hour ahead, just relax. Okay, don't try to jump and waste your gunpowder. So the same law applicable fuel in terms of the journey is concerned. Okay, so the same law applicable with respect to the investing also is concerned. So suppose if my capital is doubled within a short span of time, better to take back the capital and stay invested with the additional amount. And pyramiding is always essential for the investors, especially in the mid and small cap space, because whenever the stock multiplies or gives a significant returns, the margin of safety in that particular stock, gradually it will come down. So if the investor is much confident about the earning visibility of this company, if there is a earning expansion that's going to take place, then there's no problem. If the investor have that kind of cognizance and knowledge. If the investors don't have such knowledge, always pyramiding, taking back the capital is extremely important in these kind of market, because whenever there are sudden spots in the markets, one need to be always cautious. Of course, caution is the word, the advice where everyone gives at all the levels of the market. But taking back the money, okay, right, one need to know when to sow a seed and when to pluck the fruit from the tree. That's extremely crucial in the markets. If anyone is just waiting for the fruit, sometimes it can become rotten or fall down from the tree. So it's an art. One need to know when to sow a seed and when to pluck the fruit from the tree. Also extremely crucial in equity markets.
All right. And moving on, HDFC Bank has come out with its Q3 business updates. I'll come to you in just a bit, but let's just look at the numbers first. Now, India's largest private sector lender, HDFC Bank, reported a 62.4% YOY or year-on-year jump in its gross advances for the December quarter. On a sequential basis, however, gross advances were up about 4.9% or so. The domestic retail loans, that skyrocketed by about 111% again on a year-on-year basis, but on a sequential basis, they were up somewhere around 3% or so. The bank's deposits saw a 27.7% uptick year-on-year, but a meager 1.9% growth sequentially. CASA ratio, the current account saving account ratio, stood at around 37.7% in Q3 FY24 compared to 44% in the year ago period. However, on a sequential basis, it improved marginally by about 10 basis points or so. Now, a higher CASA ratio is generally considered favorable for a bank, as it indicates a larger share of low cost and stable funds, which can contribute to net interest margin and improve the profitability of the bank. But remember that the numbers on a year-on-year basis are not comparable, and last year's numbers are just that of HDFC Bank, whereas Q3 and Q2 numbers are of the merged entity, which meaning includes the numbers of HDFC as well, which by the way, remember the merger came into effect in July 1, 2023. Coming to you, Kranthi, how are the numbers looking? Deposit growth at about 2% quarter on quarter seems to be lower than what the street was estimating, isn't it?
Yeah, you made the disclosure, comparing the year-on-year comparison because of the merger is there. Now it's a standalone entity at this point of time. And Suyash, it's the largest financial conglomerate, HDFC Bank and HDFC Limited. When they got combined together, there are a lot of things get merged together, the books and all. So the one thing I can see is, even though the pace is slow, but it's running in a positive direction at this point of time. But one quarter numbers, we need to allow the bank to settle down, because the bank is the second largest bank, second largest company in India with terms of the market capitalization. So we need to allow the bank to give ample time, probably one more quarter, okay, to just to see the brighter spots at this point of time. Right now, yes, the numbers seems to be less if you do the comparison quarter on quarter, but there is a aberration when we compare year on year. Okay, so it's moving in a positive direction. That's where we can see the same thing. We can see the reflection in the stock price also. The stock was in the consolidation. Now it is in very baby steps. It is inching upwards. So most probably we need to wait. Quarter on quarter comparison is slightly a shorter term at this point of time, because of the size and scale of the business is concerned. Most probably we need to give, of course, because as a regulatory norm, they need to give quarterly disclosures, but we need to allow the bank, the management, to settle down further to show the strong set of numbers going ahead.
All right, wait and watch. That's the call on HDFC Bank. Kranthi sir, always a pleasure talking to you. Thank you for joining us here on Last Tick, and a very, very happy new year to you, sir.
Thanks, Suyash. Always my pleasure to share my views with you and the viewers of News 9. Thank you.
Thank you, sir.